So first of all, on this balance sheet, what's really key is that in working with a lot of small businesses over the years, what I have found is that this is the one financial report that most small businesses neglect time and time again. And it really is just as important as your profit and loss statement. If you're ever going to a lender to borrow funds, or you're looking for a partner or an investor, one of the first things they're going to want are accurate, up-to-date financial statements. That's going to include a balance sheet and your profit and loss, cash flow. And what's so important about the balance sheet is that it is truly a snapshot of where your business is at financially at any given point in time. This particular balance sheet that we're looking at is through December 31st of 2026. So I'm going to start by looking at the very bottom. We're going to go down to the equity section first. So what that equity section is telling you, if you look at total equity, there's a balance of 307, 273.42. On paper, that is the value of this company. So the retained earnings figure of 301,000, what that retained earnings number represents is the cumulative impact of your business's net income or net loss from day one when you started the business. So if you started this business, I know we're in the future of 2026, but if you started this business January 1 of 2020, that 301,000 represents your net income or your net loss every year through December 31st of 2025. January 1, that turns over and starts for the current year. By that, if you look at the net income number, that 5,633.97 for the year of 2026, that was the net income that the company made. January 1 of 2027, that 5,633.97 will be added to your retained earnings number of 301,639. So if I change the date of this balance sheet to January 1, see how that retained earnings number changed to 307,273.42. So your net income or your net loss closes out at the end of the year and goes into your retained earnings figure. So that's a cumulative number. The other section on retained earnings that's really key, that verbiage will be different. If you're a sole proprietor, you're going to have member draws, you're going to have member contributions, or I'm sorry, owner draws, owner contributions. If you're an LLC, whether you're a single member or a multi-member LLC, that equity verbiage will be different. It'll be member contributions, member draws. If you're a corporation, an S Corp or a C Corp, you'll be a stockholder. So that verbiage should tie to the type of legal entity that you are in the equity section. The other thing that's really key about the balance sheet is understanding the information that it gives you. So now we're going to go to the very top. We're going to look at current assets. So assets in general are things that add value to your business. You've got cash, you've got savings accounts, you have investments. And when you're looking at your assets, the most liquid assets are listed first. So obviously cash is by far your most liquid asset. Then it's going to be receivables. Then it could be investments. So we've got our checking account, we have our savings account, we have our accounts receivable. Then you have your inventories. And not all of you in your business structure or entity may deal with inventories. You could be a service oriented business where you're just providing services, that is your product. Then we move into your fixed assets. This is key. Your fixed assets are going to include office equipment, computers, desks, chairs. If people don't think of it, refrigerators, coffee pots, anything that you have sitting around in your office, it's going to be any type of equipment, shredders, copiers. If you have a vehicle, it's going to be all of your vehicles. If you have other types of equipment. So those assets over time are what add value to your balance sheet. It add value to your total assets, and you will also, on those fixed assets, be depreciating those over a period of time, depending on what type of asset it is. So you have to have your assets complete. You have to know what you have in order to get down to your total equity at the bottom. But you also have to know what your liabilities are. So as we move through this balance sheet and we take a look at our liability section, you've got current liabilities. So accounts payable is going to be any vendor that you currently owe. It could be a utility company. It could be for inventory. It could be for supplies. Other current payables could be federal or state income taxes that are due by the business. It could be payroll tax. It could be sales tax. Then we move into other current liabilities. That could be a line of credit. You've got long-term liabilities, which would be a loan to a mortgage company or a lender like SCED. Now, when you're dealing with a mortgage or a long-term loan, up in your current liabilities, you're also going to have that current portion of that long-term debt that would be due. So it would actually, the current portion would show up in current liabilities, and then the remainder would show down in your long-term liabilities. So as you go through the year, I'm going to customize this report. I'm going to show a previous year. So I have now added the balance sheet as of December 31st of 2025, and it's added a column over here in net change by dollars. So this is also a great comparative tool, because if we look down at our equity, it really hasn't, there's no changes here. So let's try this. Okay. I'm gonna pull up a different sample company because I really want you to see that comparative from year to year.
And I just want to chime in that I'm in agreement with Shelley that we often do see the balance sheet being neglected in terms of what financial statements are provided. It's something that's even necessary for startup businesses. Although, you know, if you're starting your business, you may not have very many assets, but you may have cash that can be listed there, or you may have you know, financing that you've already received that needs to be accounted for. So it is applicable for and very important, and we do see it excluded quite often. So
See if we could. All right, none of these sample companies have comparative data. What I was hoping to accomplish here, and I'll just make this a talking point. In your current financial records, if you run a comparative from current year to prior year, you'll get a total in the net change. So if we're looking at our checking account, and let's say in December 31st of 2025, we had 50,000, and your checking account would have increased by 19,000. So that 19,000 would have an impact down here in your equity. If that was the only change for the whole year, your equity would increase by 19,000. That means that your company just increased its value by 19,000. The same concept if we're looking at debt. If you take on debt, if we look at our current liabilities, let's say our accounts payable actually increased by 10,000. So your net worth just decreased for the year by $10,000 because your balance from 2025 to 2026 increased by 10K. You took on additional debt. You just reduced the net value of your company. So what you're really wanting to see is you're wanting to see that net worth increase month over month, quarter by quarter, year by year. You want that net worth to increase in value. So when I look at a balance sheet, typically, again, for a small client, like I said previously, this is one of the most underutilized reports that small businesses don't keep up, but it's actually one of the most important financial tools. Again, I can't stress enough, if you're going to the bank to get funding or going to SCED to get funding or looking for a partner or an investor, even a short-term loan, not necessarily long-term financing, they want to know what your balance sheet looks like, because this balance sheet can tell you so many things. I'm going to take this comparative off.
So Shelley, I'd just like to comment on that as well. As I had mentioned previously, in this volatile economy, when you're coming to Tyler and I, because you're having cash constraints, there's really little that we can do without updated primary financial statements, and that includes a balance sheet. And through her demonstration of the importance of a balance sheet, you can see how Tyler and I are going to organize exactly what's going on with the business through this report. Shelley, do you want to talk a little bit, and maybe you're getting there, but in addition, lenders also want to see, there's a certain ratio criteria that they want to see that the cash is growing. And so at the end of the year, is that how is the equity line creating that ratio that shows that cash is growing year over year?
No, so we'll get to the ROIs, and there's several. One of the other key points that I want to talk about on this balance sheet that really kind of ties in what you just referred to, Natalie. If we're looking at this balance sheet, we've got $143,000 of total current assets. We've got $97,000 in inventory. Scroll back up there. We've got $69,000 of cash. So from a liquidity standpoint, if this business were to shut down today, they have current liabilities of $52,000. They've got current liabilities of $75,000. Now, I'm not including my current assets. I'm not including inventory. Inventory is not as liquid as cash and or accounts receivable. So at the end of the day, I would have $75,000 of liquid assets that I could pay my current liabilities of $35,000. So I'm going to have about $40,000 surplus there. So this is where going back into the ROIs, and I'll flip over to that handout, is really key. It's so much more than just looking at your equity and making sure that that equity is growing year after year, but you can look at your balance sheet and you can look at your total current assets compared to your current liability to see if you have enough cash flow to manage your current operations. Also, if you're looking at your accounts receivable too, then you want to make sure that that accounts receivable balance, and this particular company doesn't, they don't have an AR balance. You want to make sure that if that AR balance is growing, that your sales are growing to justify the increase. Because if your sales aren't growing, but your accounts receivable is increasing, that means you're doing a poor job of collection. You're not getting paid for your services, so that accounts receivable balance is going to increase. I'm going to share this handout with you guys, and we'll go over some of these basic ROIs. So, you know, part of the key aspects of understanding your financial statements is understanding the financial health. That gets into being able to know how to review and analyze your financial statements, being able to determine what your financial position is within your industry and just as a standalone. So I'm going to come down here to the ROIs, or the key performance indicators. So one of the first ones we talk about is your gross profit margin. So if you have that handy, I'm going to go back over to QuickBooks, and I'm going to share the P&L so you can kind of see where these numbers are coming from.
And that document has been put in the chat if you guys want to download that document to look at.
I'm going to run a P&L.
Additionally, we can provide industry data if needed. So
And that
just let us know if you would like that.
And that is really important. If you have access to that, it kind of tells you where you're at financially within your own industry. Are you pricing your services? Is your balance sheet comparable to what other entities within your industry are? It really gives you some good information to make some comparatives. So the first KPI that we're looking at is your gross margin ratio. And I put the formulas under each KPI. So your gross profit margin is revenue minus your cost of sales divided by revenue to come up with a percentage. And we're just going to walk through several of these. So then you've got, and on that gross margin or gross profit margin, there's a little IS before that. That means that that's coming from the income statement or the profit and loss. So it's just kind of a little tool to help you remember what financial statement that you're going to go look at to pull that KPI. Then you come down to your net profit margin. It's a profitability ratio that measures what percentage of your revenue and other income is left after you subtract all of your costs. Those are very common. Then we come down to your working capital. This is key. This is one of the key indicators that a lender like SCAD is going to be looking at. This is something that Natalie had touched on briefly a little bit ago. So the working capital is a measure of your business's available operating liquidity or operating cash, which can be used to fund your day-to-day operations. So this particular company has a 0.8 ratio. And as you can see, to get to your working capital ROI, it's current assets less your current liabilities. So in this case, if we're looking at the balance sheet on this sample company that I have pulled up, take this back to last fiscal year. We've got $74,408 and in total current liabilities, we've got $52,615. So our ratio is going to be a 1+. So the higher the working capital ratio, the better your liquidity is in order for you to be able to fund your current operations out of your current operating capital. Then you've got your current ratio, which is another key indicator. This is taking your current assets divided by your current liabilities. And again, if you look at that current ratio, it's got BS in front of it. That's, by the way, stands for balance sheet. Then as we keep going through these ratios, we've got quick ratio, which is another key KPI. It's also known as your acid test ratio. It's another type of liquidity ratio that measures a business ability to handle short-term obligations. It uses highly liquid assets such as your cash, marketable securities, investments, receivables, and the ability to turn those assets into quick cash if needed. Then we've got our debt to equity ratio. We've got inventory turnover, another key indicator. Return on equity, another great KPI. Return on assets, another great one if you're looking at spending some money on capital improvements, expenditures. Definitely want to know what your return on the asset's going to be before you invest the money. Receivables turnover, if you are dealing with receivables, you want to know within your business how often your receivables are getting collected. That's key. And that's another area that I see in small businesses, that receivables are not really managed and they're not staying on top of collection activity, not getting invoices sent out timely, not corresponding with the clients, possibly not sending out statements. Some of the other key indicators, net operating cash flow, there's a host of different KPIs that are all really relevant to managing your company, and doing the KPIs on a routine basis allows you the information for you to make good decisions within your business. So the challenge for each and every one of you out there on this class today is really to pull up your balance sheet and make sure that it's accurate. And we can spend a lot more time on these KPIs, but I want to touch on these financial statements a little more because there's some additional information that I think is very helpful for you to come back to this PDF as a guide and a resource. Because if you don't have your balance sheet cleaned up and you don't have a clean set of numbers, these ratios are not going to do you any good. They'll be meaningless. So they had talked earlier about how important is it to maintain your books? Is that something we do daily, weekly, monthly? Do we wait till the end of the year when we file our tax return? Absolutely not. You want your data to be as current as possible. You want to keep it up, primarily because I have clients that come in that have done no bookkeeping for a whole year. And one of the biggest problems is memory. We go back to January of 2022 and we're trying to remember what we spent $5,000 on. Did we buy equipment? Was it a loan? You know, we don't remember. So if you stay on top of it, it's easier to maintain. But there should be daily, weekly, monthly, quarterly, semi-annual processes that you go through to keep your books current. And your accountant, at the end of the year, if you walk into his office with a set of books that make no sense, there's really no good data, and that accountant has to clean it up, you're going to pay more to have that tax return done at the end of the year, because they're having to go through and do the cleanup. Then if it would have just been maintained throughout the year, it would have made your life easier. You would have had good financial information to make good decisions. You could be in compliance with your lender like SCED or any other bank, where you're giving them accurate financials. It gives them the ability, if you want to go back and borrow more money with a lender, it gives them the ability to see that you're consistently keeping your financials up to date, that you're invested, you're involved. So it really is key to keep up your financial statements. If you don't, you can't really use your financial statements to make good decisions because you're missing data. So that old adage, garbage in, garbage out, is so true. So when you're looking at your financials or a lender, one of the first things they want to know is that at year end, we just finished 2022, if every one of these accounts on your balance sheet is reconciled, then when you make an adjustment, there's only two things that can happen. You're either adjusting another account on your balance sheet to make it accurate, or you're adjusting your profit and loss statement. Those are the only two things that can happen. But if you know your balance sheet is accurate and all those accounts are reconciled month over month, then you know you've got the best set of financial statements you can have. And you also know that you've got a good set of numbers to make good decisions. So I want to touch on this balance sheet one more time. When we come down here and we look at the net income, this particular company has current year net income of $18,624. So I'm going to run the profit and loss for last year and see that net income number, $18,624. Then we know that those numbers tie, they're balancing with each other. So that's a good thing. The other thing, if you're using a software to run your financial statements, make sure you're cognizant of whether you're running those financial statements on an accrual or cash basis. So if you are running a cash basis financial, then you want to make sure that when you're looking at your ratios and you're looking at a balance sheet, that you're using the same method of accounting, whether it be cash or accrual, on the profit and loss and the balance sheet. The other thing I want to talk about on—
Shelley,
Yes.
will you real quick just explain a quick difference between what cash versus accrual reporting is?
Sure, absolutely.
Thank you.
So when you're working on a cash basis, you recognize income and expense when you get paid for a service or you pay for an expense. On an accrual basis, you recognize income and or expense when that transaction occurs. So if you give your clients, if you bill your clients and you give them, you know, a week or 30 days to pay for your services, that would be an accrual basis, because you recognize the income the day you created the invoice, but they may not pay you for 30 days. So on a financial statement, if you billed me $100 and I'm not paying you for $30 or 30 days, I'm going to recognize $100 worth of income. On a cash basis, my income would be zero, because even though you've created the invoice, I'm not going to pay you for 30 days. So you won't recognize that income until you actually receive payment for it. And that's really also key when you file your first tax return. Whatever your accountant and you have decided whether you're going to file cash or accrual, that's not something that you can willy-nilly change every year when you file a tax return. If you file your first tax return on a cash basis, you have to continue to file on a cash basis unless you file a statement with the IRS that you want to change your accounting method. Now, an accrual basis is actually a more accurate form of, or a more accurate method of accounting, because it accounts for the transactions when they occur. Cash basis is typically what most small businesses use on their tax return and when they're managing their bank account or their financial statements. But the other thing I want to touch on real quick too, I guarantee you, most of you out there, how you manage your business right now is off of your bank statement. You're looking at what bank deposits have hit. You're looking at what expenditures have hit. You're looking at your balance in your account to see what's cleared, what's not cleared, and figuring out what's left in your account to pay. If you're keeping your financial statements updated, and you are using QuickBooks as an accounting software, or it doesn't have to be QuickBooks, it can be any accounting process. And really the best accounting process, whether it be a software application, Excel spreadsheets, or a paper accounting system like Dome or Ideal Bookkeeping Systems, is one that you truly use and you use consistently. One of the other things that I see in financial statements on the profit and loss is consistency in coding your expenditures and your revenue. I'm a firm believer that in your profit and loss, the more income statements, the more expense accounts that you have set up in your chart of accounts, the better. And I use that analogy of, if I use more expense accounts to describe the type of expenditures I have for my business, or more income accounts to differentiate the different types of income I have coming in from my services or products, I'm lazy. It keeps me from getting up and walking across the room to a file cabinet and pulling open a drawer and trying to figure out, if I have one account called income and I have 10 different services, I want to be able to break that out. I want to know, possibly, of those 10 different services that I'm generating income, what on the expense side do I have that are directly related to those 10 types of income that I'm creating? So more detail in my account gives me the ability to make better financial decisions. So I'm going to stop for a minute, and I'd like to just open this up for a chat if anybody has any questions. I know we've gone over quite a bit of material, and like I said on the front side, this is not something that we can cover in 30 minutes, 45 minutes, or even an hour. Just being able to go through each and every one of these KPIs that's on that handout is going to be time consuming, but it will be well worth it. And I would suggest that all of you actually go through all of these ratios and try to look at those and try to relate your own set of financial statements to each and every one of those. And I'd go through and read this documentation. It gives you a lot of just fundamental information about running and managing your business. And the last part of this handout, get to page 16, 17, financial skills all managers should have. I'd really hone in on that. It's kind of a checklist. It's kind of a cookbook that helps you determine what you need to be looking at. And it will go back in and reference all of these KPIs that are on the front end of this handout. So any questions?
So Shelley, before we go to questions, I would like to assure everyone throughout the presentation, I believe that we've identified we need Shelley back more readily. I believe that this financial training is so key in this economy right now. And so some things that I'm thinking of as we've gone through the presentation is to have Shelley come back to kind of really help us organize all of you on how do we put together those daily, monthly, quarterly, semi-annual, and annual financial statement tasks. How do we organize our thought process for those of us who have not had the level of educational or skilled training that Shelley has? So I would like to identify something that could help us, and then even coming back and having her on another topic regarding those skills for business owners, like those financial management skills. So I think those are some things. In addition to potential new webinars, you also have the option to work with Shelley one-on-one. I know some of you already are, but I just wanted to at least put that out there. So again, we'll turn this over to all of you guys. Drop your questions in the chat, unmute yourself, email Lauren, give us that feedback, because we want to provide value-added trainings and solutions to your business needs.
And Shelley, there already is one question in the chat for you.
Okay.
And hi, my name is Jaya, and I put that question in the chat. So when you were referring to categorizing things, that's kind of where my question came from. Are there types of categories that beginners often forget about? Because you mentioned you want as many categories as possible. Is there things that are commonly overlooked?
I think probably one of the biggest things, and it's a non-cash item, it's depreciation expense or amortization expense. So when you get a tax return done by your preparer and you've got assets that you're depreciating and there's a depreciation schedule. So that's probably one of the ones off the top of my head, but it's also taking marketing, for example, is one I see a lot of. There's a difference between social media and marketing. So in social media, you've got Facebook, you've got Instagram, you've got Twitter, you've got all of these different social media platforms. Instead of having one account called social media that's capturing all of those expenses, social media would be a main account, and you'd have sub accounts. You'd capture all of your Facebook, all of your Instagram, Twitter, whatever the case may be. It gives you the ability to take a main expense and break it down into smaller categories and really see where you're spending your money. So you're getting more detail. You know what you're spending on each social platform, but you can also do that on your website. I see computer and internet all lumped together. So you can have internet fees, you can have web design, you can have hosting. Again, I'd rather see that all broken out by type of expense so I can really see where I'm spending my money in what specific category. And
then
I
whenever you're meeting with different resources, right? If you come meet with me for marketing and you're saying, well, I'm spending, $100 a month on social media, I'm going to want to know, okay, well, if you have that broken down and you can say, well, I'm spending $50 a month on Facebook and I'm getting nothing out of it, well, then you'll know that's $50 you don't need to be spending. Or if you're saying I'm spending $50 a month on Facebook and every lead I ever have comes from Facebook, well, that's good information for you to know, but it helps you more to be able to see it in your profit and loss statement, to see that expense coming out. So you can tie, is that expense useful? Is that expense necessary? Is that an expense I can just cut right out?
Well, and another key component is when people set up their chart of accounts, that chart of accounts is the backbone of your business reporting. It is so important that there's a method to the madness. It gets really, really key on the income side, or the profit and loss side, is if you've got income coming from different sources, do you understand the difference between cost of goods sold and expenses? Do you know what your direct expenses are? And how you set that up in your chart of accounts really correlates to the value of the information you get from that profit and loss statement. So understanding that and how that impacts your business, just knowing what your direct expenses are versus indirect, because it gives you gross profit margins, gross profits, and how you even design that chart of accounts. And within every industry, there are specific accounts that are unique to each industry. You may hear when you take your set of books to an accountant to prepare a tax return, a lot of accountants don't like all the detail on that chart of accounts, because when they're keying in a tax return, they have to summarize some of that information. Well, this is my take on it. Too bad. You're setting up these financial statements for your benefit, not your accountant or not your tax preparer. You're setting up these financial statements so that they make sense to you and you can make good financial decisions based on those financial statements. You're first and foremost the most important person. That's my take. Take it for what it's worth. But people start a business, and I just love it because they think, oh, I'm going to start a business and I'm going to make lots of money and I'm going to work less. And it's running a business takes a lot. You have to wear sometimes 10 different hats. You have to be the social media rep. You got to be the marketer. You got to be the salesperson. And we don't all wear those 10 hats equally. I hate marketing. That's my least favorite thing. So what do you think is the most deficient aspect of my business? It's going to be marketing. So wear the hat that you wear well and do it well. And that means if you have to outsource some of the things that you don't do well, and you're thinking, oh gosh, do I want to spend the money to do that? Well, that money may end up saving you money in the long road because you've got a better set of financials, whether it be marketing or selling or accounting or bookkeeping or tax, whatever the case may be. Does that make sense?
Yeah, those are great points, Shelley. I definitely agree with you in terms of delegation and identifying your strengths. I know we are close to the end of the hour. We've got potentially one more question in the chat, and then we can also ask the audience. Can you summarize for us, Shelley, what are the main differences between the balance sheet and the profit and loss statement?
Okay, the balance sheet is a snapshot of what represents your company in terms of value. It tells you what you have in assets, what you own, and it also tells you what debt you have. So it's the overall health of your company. The profit and loss just tells you whether you're making money over a period of time, and you get to pick that period of time. The profit and loss statement reflects a period, let's say the month of December. When that month of December is gone, you're moving on to the next month. The balance sheet is cumulative, meaning that your cash balances, your receivables, your payables, those balances move forward every month based on day one when you started your business. So at the end of the day, they both have a key role in you determining what information you glean for each statement. The P&L is going to tell you if you're selling your product for enough money and you've got your expenses under control and you're making enough net income or net profit. The balance sheet tells you how you're utilizing your resources, your cash, any type of debt. Are you funding your operations with debt? Are you funding your day-to-day operations with just general cash income received from your clients? So again, balance sheet really is a key financial report. We didn't really touch on cash flow today. That's another equally important financial report, but I think most small businesses need to grasp the importance of the P&L and the balance sheet first before they can even move on to the cash flow. That's my recommendation.